Hi guys. Right, I'm. This is the second part of the thinking behind make or buy. So in the last video, just before, just the one prior to this, I talked about make or buy being this focus on us focusing on the marginal cost, or if you like, the variable cost of making an item in-house against what price you're being offered as to whether or not you should buy the product or not. And that's typically the general idea. Now, as well as the cost of making the product, we also have to think about the opportunity cost. Now, the econ students might know this. In business studies, you might have looked at this. But what does this mean? Now, opportunity cost really is an economic concept. It's not an accounting concept. It's an economic concept, and it really, what we're saying here is that the marginal cost of making a product, or if you like, every time you're making something in your factory, you could be using that machine to make something else. And the fact that you're using that machine to make something in your factory means that you are losing out on what other thing that machine could be making. So I guess it's very similar to the idea that when you come to class, the fact that you are in class, there is a cost to you being in class, the initial cost. When I say initial, there's, if you like, a money cost. So you might come to class and you all pay about roughly £5,000 each to be in class. The government pays that on your behalf, if you like. Now, as well as this cost of you being in class, you could be working. And if you like, if you were working, so if you weren't in class, where would you be? That's what we refer to as the opportunity cost, the next best alternative, if you like. So as a result of you being in class, you can't be somewhere else. And that, what you're missing out on, so to speak, that benefit that you're missing out on is referred to as the opportunity cost. So if you could be working for the year, so for example, if you could get a little part-time job and you could be getting about, say, £16,000 a year, the full cost, if you like, of you therefore being with us in the classroom is the £5,000 and the £16,000 that you're losing out on for being in class, and we refer to this as the opportunity cost. So, as far as economics is concerned, a cost is not quite complete until we also consider that alternative benefit forgone. So, like in your case, you pay £5,000 and you also have to consider this 16,000 kind of conceptual cost that you are missing out on. So the argument is that as well as the cost of making something, you must add to it the benefit you lose by making that something and not making whatever something else you could have been making. And we'll do an example in a second. So you need your textbook. I mean, on purpose, I've constantly put these in there so that you can be using your textbook at the same time. You need your textbook. You pause this if you have to get your textbook. Go to page 409. We're going to be doing an exercise from that page. That is page 409, and the question I'm interested in is question 21.3. Question 21.3. So pause this if you need to go and get your textbook, but you need to have your textbook open. Right, so what do we have now? It says here, read the question quickly, and just make sure you familiarize yourself with the terms. It says here that Pentland Pumps manufactures electric pumping equipment used in industry and agriculture, and currently all the parts are made in-house from raw materials, and the company is thinking about buying in some pumps from an outside supplier in order to release facilities for a new product, something referred to as an old world hand pump. So they're thinking about buying in another product. But so really this machine, if you like, does have, if you like, it could be used for two things, so to speak. It can be used to make electric pumping equipment, just normal electric pumping equipment, or it could be used, if you like to use this, it could be used to make this thing called an old world hand pump. Those are your options. Right, so first of all, let's focus and let's look at what the actual marginal cost is of making this product in-house. The marginal cost. The marginal cost is the variable cost. Ignore the fixed cost. So the marginal cost, if you like, is the direct material, the direct labor, and the variable overheads. So that's 40, 25, and 20, right? That's your marginal cost. That's your variable cost. I'm ignoring the fixed cost. I talked about this in my last lecture. When we're making these type of decisions right now, we're past breaking even. Fixed costs are covered. So we're not even interested in fixed costs. These are short-term decisions right now. And so right now the marginal cost, if you like, is 85. 85 pounds, right? I add all these together. That's 85. That's the marginal cost. And it tells me that I'm making 3,500 pumps. So 85 times 3,500 pumps. Let me just get my calculator. 85 times 3,500. So currently my marginal cost is 297,500. That's just the marginal cost of making the pumps. Now if you flick over to the next page, it says to you that the opportunity cost, it doesn't say directly, but it tells you that every time as you're using this machine to make these pumps, you're losing out. That if you weren't using the machine to make these pumps, the next best alternative would be to make it says if pump motors were bought in from an outside supplier, the company would be able to make 750 old world hand pumps with a selling price of 250 and a cost of 150. Now remember, I said that it was the benefit foregone. The benefit foregone is the difference. It's the actual profit. So it's not about the revenue. I must consider the cost as well of this benefit. So it's the actual net benefit, so to speak, or what we would call contribution, right? The selling price minus its variable cost. So the alternative foregone, the next best alternative, is to be earning, if you like, £100 on these 750 oldie pumps. And if I multiply that 750, I will get 75,000. So really the full cost, according to economists, is not just this 297,500 of you making it in-house, but you also need to add on this opportunity cost. So we need to add on the 297,500 plus the 75,000. Right, plus the 75,000, and that gives us 372,500. That is the full cost of making these pumps. Now what we need to compare this with is someone is offering to give us these pumps, if you like, for us to buy these pumps from an outside supplier. So this is, do we make it in-house? That's the cost of making it in-house, or do we buy it from outside? And that's 95 per motor times the 3,500 pumps that we're being asked that we need. So we have 95 times 3,500, and if you like, what you now have is 95 times 3,500, and you have 332,500. So it is actually cheaper to buy this thing from outside, because 332,500 is less than 372,500 by 40,000. So we would actually have a saving of 40,000. Whoops! If we buy it from outside. Okay, great stuff. So I think that's kind of the. I'll just show you one little sort of, just prove this again, if you like, in another very sort of different, fashion. If we had, so you can see the difference here is 40,000. Say for example, I had actually decided, you know what, we're going to buy the pumps in. So say for example, I bought the pumps in. When I buy the pumps in, I would buy the pumps in, like for what I just said, for 332,500. So because I bought the pumps in for 332,500, that's a cost, of course, right? But because I bought the pumps in, I'd be able to use the machine to make those, if you like, make the hand pumps for 75,000. So, sorry, yes, for 75,000. So, I mean, if you like, this is a kind of, this is income, if you like. This is a benefit. So that's the cost versus this against, I bought the pumps in, and because I bought the pumps in, I can now use the machine to make that. So when you take, if you said, okay, so what's the net kind of cost, so to speak? 332,500 minus the 75,000, if you like, that's 257. The net cost, if you like, is 257,500, as opposed to me actually ignoring this and just making the pumps in-house. And we already know the cost of making the pumps in-house was 297,500. So we can see that if both ways we look at this, this is the cost of making them in-house, and this is the net cost of buying the pumps in. I buy them in, and I can then use the machine to generate money via the OD pumps, and I actually have made a benefit of 75, a cost of this. So the net cost of buying them in is 257 versus me making them in-house, therefore still saving, you can see, the 40,000. So two ways to sort of look at what's really going on here. But what I recommend is you do it the traditional way. Find the marginal cost of making the thing, add on the what's it called, the opportunity cost, and that's your full cost, and compare that with the selling price, so to speak, or how much you would have to pay if you had to buy it in. Right, so that concludes our this video on make or buy, and then in the next video we will see another use of marginal costing.